Well, welcome to Bloomberg. Quint. Finance Minister Nirmala Sitharaman has presented a maiden budget and a lot of announcements for foreign investors as well. So what are foreign investors making of the budget? The initial take, that is. Let's take this question to our experts. Joining us right now on the show are Lucy Macdonald of Allianz Global Investors. Lucy, thanks so much for taking the time out and speaking to us here at Bloomberg Quint India. This is Neeraj Shah here. 2 or 3 things that have been announced in the budget. The minimum public shareholding of companies has been raised or will be raised to 35% from 25%, which means more supply in the Indian markets. There is a social stock exchange, which is the listing of social organizations and voluntary organizations. And India is talking about having an annual global investors meet as well with sovereign wealth funds, digital venture funds, etc. I mean, a lot of things from a foreign investor's perspective. What stood out for you?
Well, the overall liberalisation move, both as far as bonds and equity is concerned, is very welcome. For the budget as a whole, standing back, it looks like a good balance between fiscal rectitude and necessary stimulus. And looking at the what's been happening with interest rates anyway, you've got some monetary stimulus and then you've got some fiscal stimulus, some more spending coming through in infrastructure, a little bit more help to SMEs in tax. So it looks like a good balance, I say.
Lucy, the other aspects, one being the fact that now they're looking to allow FPIs to subscribe to listed debt paper as well as REITs, and also looking at merging the NRI portfolio investment with the foreign portfolio route. How does that play?
Well, we haven't looked at all of the detail yet. So I think the fact that the mood is to liberalise, to allow global bonds and to encourage more investment, private investment into to stimulate growth is all favourable as far as we're concerned.
Just also comment on the fact that now they're looking at going offshore to raise more money. We're talking about raising money via the external route. Will that probably bring about some more uncertainty from an India standpoint, if at all there are any global jitters that could affect India more negatively?
Clearly, it gives a little bit more sensitivity to global financial markets. From a starting point of zero, I think that risk of taking a little bit more is probably warranted. And particularly at the moment where you have an absolute thirst for yield in global financial markets, it seems wise to tap that if it's possible to do so. And we're seeing yields everywhere falling from even low levels that they're at the moment. So I think it's an opportune time to be doing it.
Okay, Lucy, stay on with us while we also have Mark Matthews of Bank Julius Baer. And Mark, hi, thanks a lot for joining us. Good afternoon to you from India. What have been the highlights for you for this budget? In fact, the FM categorically acknowledged the FPI participation. In fact, the inflows that we've received from the FPI community so far this year. And they've also rationalized the KYC norms, I think, which were not suiting the FPI community. What stood out in the budget for you, and was there anything more that the FM should have done?
What stood out for me were 5 things. 4 were good and 1 was bad. So the 4 good ones were the sovereign offshore bond, which is very good given that external debt is something like only 5% of GDP in India. And that'll create a yield curve, which the country doesn't have now. And then the housing finance companies falling directly under the jurisdiction of the RBI, I think will create more stricter oversight, which is a good thing for the NBFC sector. And then the government committing to put 70,000 crores, I think, into the banking sector, recapitalizing the banks. Undoubtedly a good thing. Free float increasing up to 35%. I take it as a positive. I don't think it's good to have a lot of stocks trading on a stock market that have thin liquidity. The only thing that soured the mood, and it explains why the Nifty's down, is that they're taxing the super rich even more. And of course, markets don't like taxation. But 4 out of 5 is a good number, so broadly positive.
That's right. In fact, Mark, the super rich, I think the tax rate now will be somewhere between 38 to 42%. Mark, but what did you make of the fiscal deficit number, which is at 3.3%? And this has come at a time when growth has slowed down. Market was also waiting for some sort of stimulus package to be announced. And last year, the government managed to meet the target because they cut down on their expenditure. If they do so this year as well, that will hamper the growth once again.
Well, I think you're right. Going into the budget, there was an assumption, probably because of the very strong election result, that we would see more stimulus and perhaps therefore looser deficit target. And of course, it turned out to be the opposite. So maybe that's also contributing to the weakness in the stock market today. You're right. I think people were looking for a more stimulatory budget.
Lucy, from a foreign investor standpoint, now India's got a stable government. The budget has been progressive. Everything's been put in place. Just we need to shore up those growth numbers. But from an investment standpoint, from a foreign institutional investor perspective, as a market, does India still appeal?
The growth rate is slowing, and the overall valuation is on the high side. So it's not the most attractive from that perspective, but it still has better growth prospects long term than many other areas of the world, and it still has a government which is stable and wanting to stimulate that growth further with a really clear plan to be able to do that, and a mandate to be able to do it. So I think there is in a medium term a lot of potential. I think in the short term the valuations are relatively high.
On your list, where does India stand amongst emerging markets, Lucy?
We look at it very, very differently. I think what's driving India is quite idiosyncratic compared to what's driving China at the moment. So I think there's a place for both. They have different drivers.
Mark, India still remains an expensive market in the EM basket. In fact, the premium that it commands is only going higher. Will that still make a case to put additional or deploy more money into India?
I think that you pay for what you get, and that's why India is expensive. It's the only major market in the world, apart from Brazil, that I can think of offhand, which has this extremely robust demographic profile of the working age population not peaking for many decades to come, and yet it's big and liquid. So most countries that do offer this demographic profile, they might have large populations like a Vietnam or a Bangladesh, Pakistan, Philippines. You can go down the list, but their stock markets are very illiquid and therefore not nearly as investable.
Okay, Lucy, when you look at the investment climate right now within the world, and that's something that I would want your view on, you mentioned about the pecking order wherein China and India and where do they stay. But after this budget, which seems to be progressively more favorable for foreign institutional investors, you think flows would be sanguine towards India? You yourself may like China more, but just from a global CIO perspective, do you reckon flows would be more sanguine towards India?
I think there is a lot of medium-term interest towards India, and as I say, the India versus China to us is they're idiosyncratic. They're drivers. They're very different, and I think what we'll probably keep an eye on as far as India is concerned is trade and any trade conflict with the US. So far, it's been extremely safe from the tensions we've seen elsewhere. I think we need to just keep an eye on that and to see whether there's any potential for unpleasant surprises on that score, although there's a balance between the geopolitics and the desires of the US on trade.
The other aspect, Mark, is, while we look at the growth numbers, we look at the fiscal deficit numbers, and that has its own bearing. on the yields as well as what the currency lands up doing. And now that we know that crude oil prices are supporting the currency in a big way, from foreign institutional perspective, the currency being at where it is right now, which is under 69, should be a really encouraging point to start investing more, and it actually could be viewed as a silver lining.
Well, you correctly identify, I think, the major linchpin for the...
Sorry, Mark, that was for you.
Oh, was that not for me? I apologize. Okay, I think the major linchpin that's been problematic for the emerging markets really over the last 10 years is the strength of the dollar. And so I agree, if you could stop seeing the rupee go down, that would be a big part of people becoming more interested in the Indian stock market. But I think that the determining factor will not be so much the what's going on in India. It will be what's going on in the United States and Europe, much bigger picture stuff. But if the dollar were to start to go down, I think that would really be helpful for the Indian market.
Lucy, same question to you. You had started answering. Please continue.
Yeah, I think it's absolutely right. We've seen as the Fed has gone 180 degrees the other direction and talking about lowering rates, the dollar has weakened, and you've seen the benefit to emerging markets and emerging markets currencies. So that is the major driver.
Lucy, since you already highlighted your preference between which are the markets that you like within the EM basket, but if one were to deploy fresh money into market like India, of course there are growth concerns which may continue, but which are the sectors where one can expect return? Because so far index continues to be around its all-time high levels, but that's also owing to the polarized move that we've seen by a handful of stocks.
Yeah, it tends to be stocks rather than sectors that we're looking at, but the tech sector is internationally competitive, and that's an area where in digital transformation we're still seeing good structural growth. The IT service companies are clearly up there. The move to increase infrastructure spending makes sense, so therefore road, rail. So those are the obvious places to look.
Mark, the economic survey which was laid in the parliament yesterday, they projected GDP growth of about 7% for this financial year. And of course, to achieve that 5 trillion economy mark by 2025, they also said India needs to grow by 8% after that for the next 4 years. Do you think that's achievable at least this year, considering the last quarter growth was at 5-year low?
Well, the short answer is no, but I'd sort of have to look more closely at the numbers to understand base effects and things like that. But no, I don't see how they're going to get to 8% under the current circumstances, particularly in light of a budget which was less stimulatory than had been expected.
Okay. Lucy, just, want to get in your sense as to what are going to be the key risks that you from a global standpoint, envisage that could lead to a big outflow of money, or rather probably that could curtail the money that comes into Indian shores?
Well, I think, as I mentioned, any trade conflict, which India so far has been really insulated from. And we know that there are some areas of conflict on tariffs. So I hope part of the opening up that we've seen in this budget towards foreign investment is also more broadly as far as tariffs are concerned, to encourage more companies to operate as well, and to make a more level playing field for those.
Right. Just the fact that US equity markets are also trading at record highs, and for that matter, bond traders out there are sitting on a hefty amount of cash currently. You think that it's probably that's exactly where the money is going to stay rather than come to an expensive market like India?
I think, well, as I said, with the bond, the global bond, I think there will be demand because there is this absolute hunger for yield at the moment. And at the same time, there's quite a hunger for growth. So if India can provide both yield and growth, then I think investors will be interested, certainly in the medium term. In the short term, I think India looks quite expensive, but all markets look quite expensive at the moment. So within that context, you go where the growth is.
Mark, with the recent economic data which has come from US, that's once again, tilting towards there could be a rate cut which could come end of July when there's a meeting. In fact, I believe the futures rate is already factoring some bit of rate cut. If that were to happen, how do you see the fund flows taking place between the emerging markets and the developed markets?
I would say it's beneficial for emerging markets primarily because rate cuts should intuitively be accompanied by a weak dollar. It doesn't always have to be, but if it is, then there's a very good inverse correlation between the dollar and emerging markets, and therefore I think that people would put money in emerging markets, including India.
Mark, one more question. Any key concern which is right now being highlighted by the FPI and the FII community towards the Indian markets?
The only concern, and nobody's told me this, I'm just sort of thinking it aloud as I talk to you, is that we haven't really had any follow-through rally since the election, and I frankly personally expected one. So I feel like there's some inertia now, perhaps people waiting for government policy, and perhaps they wanted to see more of that in this budget than we have seen. I'm not saying it's a bagged budget, but and we haven't got all the details yet, but I thought we would have seen more talk about labor market reform and agricultural sector reform than we have so far. But maybe that's coming. Maybe it just takes a little time.
All right, great hearing from both of you, Mark and Lucy. Really appreciate you taking out the time this afternoon and joining us. Thank you so very much.